Lesson 4. Building your passive portfolio step by step. Hello and welcome to another lesson in which I will show you how to build a simple passive portfolio. Then I will talk about rebalancing and I will show you what are the strategies available in the ST application and why we should be very careful when we are doing rebalancing in our portfolio when we take into account costs and taxes. I will talk about the impact of costs on our portfolio, commission costs, management fees, and taxes. I will also show you how to adjust the results of our portfolio for inflation and also how to convert results of our passive portfolio in our local currency. Okay, so let's move to the application. And here is the main screen. And before I will start building our portfolio, let me explain in a few sentences what the passive portfolio is. Here we can see on the screen a simple classic 60-40 portfolio, which is constructed of 60% of stocks and 40% of bonds. And the only thing which investor is doing is to keep these weights at these levels. So basically, for example, historically, stocks are growing faster than bonds. So after some time, it may happen that, for example, instead of having 60% of stocks, we would have, let's say, 70%. And then we have to do so-called rebalancing. So we have to then sell a portion of stocks to again have the model portfolio, 60% of stocks and 40% of bonds. But we don't try to be smarter than the market. We don't try to beat the market. And this is very important when we are talking about the passive portfolio. And by the way, in the subsequent lessons, I will also show you the active approach to investing and the active strategies. Okay, so let's start to build our passive portfolio. Although we have many examples of passive portfolios here already built into the application, we will build another simple passive portfolio just for the sake of learning the ST application. So let's click on the Add button and Pie Chart Investing. And here we have to set the strategy name, the portfolio name. Let's make it 60-40. We will build another 60-40 portfolio. Here in description, we can put anything we want to describe our portfolio. I will keep it as it is. And this is the most important tab for now. Entry, exit, signals. Here we have to put our elements to our portfolio. So let's start with the stocks. And let's assume that we want to have a global portfolio, which is built of developed markets, emerging markets, and bonds. So let's start with the developed markets. We put their ETF, which is registered in the United States, and let's make it, for example, iShares MSCI World as the main building block for our portfolio. And let's say that we will have it like 50% in our portfolio. We can see that this ETF is in USD. Let's then add another ETF from the ETF US group, which is built in, by the way, by default in the application. But if you want, you can, of course, import your own ETFs. And I showed that in the previous lesson. And now let's say that we want to have emerging markets. So we can enter emerging markets here and we have VWO ETF, which is FTSE Emerging Markets Index Fund by Vanguard. Let's make it 10%. So together it's 60%. And by the way, the emerging markets on the global portfolio, they are on average now around 13-14%. Here we have a bit more, but just for the sake of the example, let's make it simple. So we have 50% of this ETF and 10% of this ETF, and we can see that here as well. And we have to add bonds. And for the bonds, let's select the ETF, which has the symbol IEF. It's iShares 7-10-year Treasury Bond ETF. And because we want to have portfolio 60-40, we have 40%. So we have 60% of stocks, but they are split into two separate ETFs, and we have bonds, 40%. This is it. Let's click Save, and we have that portfolio here. And also you can see how it's built. You can see the chart of that portfolio here. So let's make a simulation using all available data for that portfolio. So I clicked All and press the button Test. Here we go. As we can see, our simulation started in 2012 and it ended in 2022. So basically we have around almost 11 years of data of simulation here. We have the starting capital $100,000, the ending capital is $188,000, and as we can see, we didn't contribute anything to our portfolio in the meantime, so we have only a single payment at the beginning. We also were not making any withdrawals from the account in the meantime. The problem here is that if we want to analyze such portfolio, it doesn't say too much. Actually, we may think that investing is really very simple because from that picture, it seems like, well, it's not that bad. After 11 years, our portfolio almost doubled. It's not that difficult, all this investing. So basically, wow, interesting topic, and we can just put our money there and that's it. Well, I would say not that fast, because the markets in the short term are not really showing us all the potential situations we may face in the future. Therefore, it's very helpful to have the analysis for a much longer period. And for that reason, we have to extend our data, because now we are using the data which is only based on ETFs. And by the way, I'm preferring, for testing purposes, at least, even if I'm not using them on the real account, to use the ETFs registered in United States, because basically they are having longer history than, for example, ETFs registered in Europe or probably in other parts of the world. So if they are tracking the same index, which we will have in our portfolio in the end, then it's probably better to use ETF, at least for simulation, which is registered in United States. If we are using the ETFs from America, we still only have a data going back to 2012. So if we want to extend that period, we have to use so-called backfill data. And luckily, in the application, we have a lot of built-in data, historical data, and I described that in the previous lesson. And for that reason, let's click on that button. So we want to set the backfill data for MSCI World. So we have to go to System Trader Group, and then we have to select World Stocks Developed Countries. In a similar fashion, we have to do with the emerging markets, again to System Trader, and here we can see emerging market stocks. And also same thing for bonds. So System Trader, and now we have to select 10-year government bonds. Okay. And now, on top of that, we can also add inflation. Inflation index will allow us to adjust our results to inflation. And this is very important, especially if we are looking into the results of our portfolio, historical results, for a long period, for decades, for example, because then adjusting such results to inflation is very, very important. Okay, so let's go to System Trader. And here on the first position, we see US Consumer Price Index, which is going, by the way, back to 1913. Okay, we can save it and let's run the simulation again. Here we go. Now we can see that our simulation goes back to 1925. So basically it's almost 100 years. And also we can see that now the field adjusted for inflation has a value. For example, in the previous simulation, that field was empty because we did not set up the data for inflation. Also, we can see that on the very long time horizon, although the ending capital is over $146 million, in fact, After adjusting for inflation, it's only 8 million. So this difference is just huge. It's huge, and we have to always remember about that, because if we look at CAGR, here in nominal terms, it's almost 8%, whereas inflation adjusted, it's almost 5%. So that difference, we can see it's there like that, but it's not that huge, we could say. But in the long term, this compounding really works. And in fact, we can see that the adjusted for inflation capital is far smaller than in the nominal terms. Okay, so we have the first step behind us. We build a simple 60-40 portfolio. But let me stop for a while and discuss a bit more the aspects of how to set the ratio between stocks and bonds, and why we wouldn't have 100% of bonds in our portfolio or 100% of stocks in our portfolio. We just have 60-40. So let's look into that a bit closer. And for that purpose, let me build a simple portfolio which is just built of 100% of bonds. So we have a portfolio called 0-100, which means 0% of stocks and 100% of bonds. And now let's put here 100% of bonds. And let's use the same ETF we used in our previous portfolio. And let's make also the backfill data so we can see for a very long time horizon. And let's make it 100%. On top of that, let's also set so-called benchmark. So we can compare bonds to stocks. And for example, in that case, let's use ETF IVV, which is iShares Core S&P 500. And also, in order to make the simulation longer, let's set the backfill data for it. Here we go. And we can save it. And now let's see what will happen. What is the difference between stocks and bonds in the very long run? And voila, here are the results. And as we can see, portfolio 0-100, which is built in 100% of bonds, is having CAGR on the level of almost 5%, whereas CAGR for S&P 500 is over 10%. So you can say that stocks are really growing much faster than bonds, but there is price for it. First of all, we can see that the maximum drawdown here for the bonds is 22%, whereas for stocks it was over 83%. Also, the standard deviation, which is a kind of volatility in our portfolio. For bonds, it's much lower. It's 8% versus almost 20% for stocks. So just keep in mind that bonds in our portfolio are not to maximize the profits, but to stabilize the portfolio. So basically, the more bonds we will put in our portfolio, we probably will have less money in the end. But if it's really needed because we can go through tougher periods thanks to having bonds in our portfolio, because our portfolio will not dive so deeply as with only stocks, for example. And if because of that we can be more disciplined, then it's worth to add more bonds to our portfolio. Of course, it's very individual how many bonds we want to have in our portfolio, but we have to try to answer that question, because if we will be too aggressive, we may have a problem when the stock markets will go down, or if we will be too defensive, we may not meet our goals, and that will be also a problem. Another thing is that I'm talking here about bonds in USD. And for example, let's make the simulation from the year 2000 and see the end result. As we can see, the portfolio had a worst time by 2020 and it was going down by over 20%. Fine. But this is in the USD. What if, for example, we are located not in the United States, but we have a euro currency? So then we see that portfolio a bit different than, for example, a person living in the United States where USD is used. And here we go. Look, The maximum drawdown now is 27%, not 22%. So basically, in Europe, for the investor, the same bonds look differently when they are converted, when the results are converted into euro. For the investor from America, the investor who's making money and spending money in American dollar. What I want to say here is that typically, if we are having no more than, let's say, 30-40% of bonds in our portfolio, we may have bonds in a foreign currency. But if our portfolio needs to be really very defensive and we want to put more than 30-40% of bonds in it, we should have bonds in our local currency in order to really stabilize the portfolio. Otherwise, our bonds will perform more or less like stocks, which is probably not what we wanted to achieve. Therefore, again, if you want to see how your portfolio is performing in your local currency, go to Money Management and specify the currency in which your portfolio is running. And also make sure that in the portfolio, the elements are in the right currency. So that ETF is registered in the United States and is in USD. However, we are investing in Europe using euro currency, and then the results will also be expressed in euro. And this is very, very important. Okay, let's go back to our portfolio and discuss rebalancing. Let's run our portfolio from 1970 to the beginning of 2000, and let's see how the simulation was performed over the years. Here we are. We have some end results. And what is interesting for us is that in rebalancing history, we can see how the portfolio looked in every single year. So in 1970, we started with a portfolio having 40% of bonds in it and 60% of stocks. And if we move to the end of the simulation, to the end of 1999, we can see that also in our portfolio we had 40% of bonds. Of course, there is a small difference here because even when we are doing so-called rebalancing, there will be small differences, but in general we could say that we have 60-40 portfolio, although we were investing for 30 years. What does it mean? It means, for example, that in 1999, we had to do so-called rebalancing because at some point, instead of having 40% of bonds in our portfolio, we had 32% of bonds in our portfolio because the stocks were growing quite rapidly and the weight of bonds in the portfolio decreased. So what we have to do? We have to sell a bit of stocks, emerging markets and developed markets. And in place of stocks, we have to buy a bit of bonds. So again, after rebalancing, this is before rebalancing and this is after rebalancing. After rebalancing, we can see that we have again 40% of bonds in our portfolio. And this is basically the whole idea. But let's go a bit deeper into that. So let's go into that portfolio and see what are the possibilities for us to set the strategy for rebalancing. In that current settings, which is by default, we have portfolio rebalance frequency set for 1 month, every 1 month. But that doesn't mean in that case that every month we are making rebalancing, because here we have bands and it says deviation 20%, which means that with that setting, we will only do rebalancing if any of this weight is deviating by more than 20%, not 20 percentage points, but 20%. So that means, for example, that if we have bonds here, 40%, 20% is 8 percentage points, which means that if the bonds go below 32% or grow above 48%, then we are triggering the rebalancing. So although we are checking every month, it's conditionally only triggered when the deviation goes behind that band. By the way, if we would set some very high bound like 99%, then probably we wouldn't make that rebalancing at all. Or we can make it like, for example, each year or each even week. But basically, the rule of thumb is that whenever we are doing rebalancing, it's better to do it conditionally, meaning that we are not doing that every month or every year, no matter what, but only if there is certain condition met. For example, that the deviation to the model portfolio is above certain threshold, like 20% in that case. Even better approach is so-called inner rails rebalancing, which means that similarly as before, we are only triggering the rebalancing when, for example, deviation is above 20%. But once we are triggering this rebalancing, we are not doing that fully, but for example, halfway, like 10%, we still allow the deviation after rebalancing. So imagine that the bonds dropped to 30%. And rather than, after rebalancing, make again 40% of bonds, we would make only 36%. We would allow 10% deviation even after rebalancing. So we would rebalance the portfolio to so-called inner rail. And because of that, we can reduce the cost of taxes and transaction costs. And on top of that, we can use also the momentum of the market. So for example, if there is a long uptrend on the stock market, we will have slightly more stocks in our portfolio because we will be rebalancing to the inner rail band, not fully. On the other hand, when the stock market is going down, then we will have slightly less stocks in our portfolio and we will have a bit more bonds in that case. And thanks to that, the performance of our portfolio can be better because we are saving money on transaction costs and also on taxes if they are present. And someone could say, so maybe it's better not to do any rebalancing. Well, you can do it as a homework, but the fact is that let's say that rather than having 60-40%, you would put here 80-20%, which means that you have 80% of stocks, 20% of bonds. After 30 years, you would have more money than if you would start with that portfolio you can see on the screen, 60-40, but you would not do any rebalancing. So after 30 years, you would end up with more or less also 80-20% bonds portfolio, because basically the amount of stocks in that portfolio would grow because we would not do any rebalancing. And as I showed you, stocks are growing faster than bonds. So slowly, year after year, the proportion of stocks in our portfolio would be higher. And after 30 years, it would be in that case around 80% of stocks versus 20% of bonds. So rather than having that after 30 years, if we would like to have that amount of risk in our portfolio, it would be better to start with that risk from the day zero or day one, 30 years before, because we would have much more money rather than go into that portfolio for 30 years progressively. Okay, so this is it when it comes to rebalancing. And just one more thing. I showed you a simulation in which we have a starting capital and we not make any contributions nor withdrawals. However, in the real world, probably you will be making some cash flows. So you will be making contributions or withdrawals to or from your portfolio. And then you can use these cash flows to also help rebalancing. And I will be talking about that more in the subsequent lesson when we will be talking about contributions and withdrawals. However, now I'm just only marking that you can set here that whenever you are contributing to your portfolio, you can do rebalancing. Not the full rebalancing, but to the extent which that cash flow is allowing you, you try to make this portfolio as close to the model portfolio as possible. And then you are reducing the impact of rebalancing in which you have to sell something which incurs the cost of, for example, commissions, which is even having probably more negative impact on your portfolio, taxes. We haven't talked about taxes yet, but taxes may be very negative in our performance. All right, so this is it for rebalancing. And now let's talk about costs. And for that reason, we will discuss the costs of commissions, taxes, and management fees. So let's start with the commissions. Go to the edit button, and in the transaction costs, we can see that we have commission plan 1 and commission plan 2. And this is basically a different type of tariff. In the plan 1, we have commissions per share, whereas in plan 2, we pay percentage of trade value. So depending on your account, on your broker, you have to set a different tariff. Let's say that we have a tariff which is 0.3%, but not less than $1. Let's say that we don't have any slippage, and let's save it, and let's see what is happening after 30 years. Voila! We can see some result, but what is interesting is to see the total commissions, and we can see over $7,000 paid in commissions. So now let's compare it to portfolio in which we wouldn't pay any commissions. So let's put 0 here and save it and run simulation again. And now we can see that in our total commissions field, we have 0 because we haven't paid any commissions. But is it really so important when we are talking about commissions? Look, here the CAGR is 12.14. And without commissions, it's 12.17. So the difference is really not that big. The adjusted for inflation ending capital, here it's 698,000. And here it's 692. So basically, the difference is around 6,000. What I wanted to say is that the difference between the portfolio with and without paid commissions is really very small. And I'm not saying that we didn't have to pay attention to commissions, we should, but in passive portfolio, they are not that important. Of course, it's better to not pay anything, but we don't have to really fight here for every single penny, because typically, especially if we are doing wise rebalancing, especially with the inner rails, then we can even more reduce the impact of commissions into our portfolio. And now let's see how the taxes are influencing our portfolio. For that reason, let's go into the settings, and let's say that we want to apply certain taxes. And of course, the taxes may be different from country to country. Let's say that we pay 20% when we are selling anything at a profit. Of course, it may be more in your country or less, or maybe you don't have to pay at all because you are not on a taxable account, but let's just to see how the taxes impact the portfolio. And let's make the simulation. And by the way, someone may ask why we would pay any taxes, because we are just only having a starting capital, we are not selling it, why we would have to consider taxes? Well, we have to do rebalancing. And just because of rebalancing, we would have to pay, in that case, over $162,000 in taxes, which is a lot, much more than we paid for the commissions. And now, let's see what happens if we wouldn't have to pay any taxes. So let's make another simulation just to see the difference. So here we can see, first of all, that there are no taxes paid because we didn't set taxes. And at the end, we have over $3 million, which is, after inflation, almost $700,000. Cool. Net after tax ending capital is exactly the same as here ending capital because we don't pay any taxes. Whereas here, we have a different case. First of all, the ending capital is 2.7 million, which means that we have less over $400,000 just because of rebalancing. In rebalancing, we paid $160,000, but because of the compounding, we lost more than $400,000 comparing to portfolio in which we wouldn't have to pay any taxes due to rebalancing. Now, that's not all the tax we have to pay, because the net after tax ending capital is even lower, because if we want to withdraw the money, we still have to pay some taxes on it. So in total, the difference between taxed and not taxed account is just huge, and therefore, if you want to reduce the cost of your investing, first of all, you should try to invest through the accounts which are not taxable accounts. But if you have to invest on the taxable accounts, you should have very wise approach to rebalancing. And therefore, again, if you are on a taxable account, I really recommend you to do two things. First is to consider using the inner rails rebalancing, which is described here also, by the way. And on top of that, to use the cash flows when you are contributing or withdrawing money to or from your account. The bottom line is that taxes are really having the most negative impact on your account in most of the cases, much higher than commissions. And now, last but not least, the fees, the management fees. Okay, so for that reason, let's set, for example, one portfolio in which we will have the management fee per annum at 0%. And basically, we have such case here because we just didn't have any taxes, no commissions, nothing. So this is such portfolio. Now, let's compare that portfolio to another one when we have the management fees at the level of 0.2%. And let's run the simulation. Voila. The result is, as you can see, $3.1 million, almost $3 million. And we paid just in fees around $47,000. Quite a lot. Less than for taxes, but still quite a lot, and more than for the commissions. But now, let's imagine that you have a super expensive portfolio. Super expensive fund, for example, which costs you like, let's say, 2% per annum. Maybe for people in United States, that's insane, but for example, in Europe, there's still a lot of funds which are taking even more than 2%. So let's save it and let's run the simulation and see what happens. Boom. Now we have 1.8 versus over $3 million when we don't have any fees. So basically, the fees after decades, they can consume even more than 50% of your capital. They are really very dangerous. Actually, together with the taxes, the management fees are very important. And just to be clear, if you are using a low-cost ETFs, which cost you like around 0.1, 0.2%, you don't have to worry. It's really not that much. And you don't have to be worried that they will consume majority of your portfolio. However, if you are paying like more than 1%, and on top of that, you're on a taxable account, then you really have to be very careful, because probably after a few decades, most of the money will not be in your pocket, but in the pocket of the tax authorities and the fund issuer. Okay, so this is it for this lesson. Just to clarify again, to build a portfolio, it's very simple, but you have to remember that if you want to make really long simulation, to use the backfill data, and then to remember about things like rebalancing strategy and the transaction costs, because they change a lot for the performance. This is it for this lesson. Thank you very much for your time and see you in the next lesson. Bye bye.